Good evening, everyone. Hello. Welcome to Tune Protect fourth quarter and full year 23 analyst briefing. This is Peter from the investor relation team. As usual, the Rohit and a couple members from the senior management team will go through the presentation. During the presentation, please keep your line muted. After the presentation, we'll proceed to Q&A. So with that, I'm going to bring up Rohit for his presentation.
Okay, hello everyone. You must have seen the one-off announcement we made about 10 days back, stemming from the decision from our regulator. So obviously that has had a material impact on our results, which was otherwise looking to be a very good year from a recovery perspective, leading into hopefully much better year in 2024. I still believe it's a small pit stop we had to take. Yes, a material one, but the fundamentals still remain very strong. Excluding the one-off Tenang impairment, actually our fourth quarter and full year 2023 profit should have been at 3.5 million and 22 million respectively. I want to start with the traffic lights we had committed. We have excluded the Tenang one because I feel it's really a one-off impact that was not within our control, but we will show you the impact with and without Tenang later as well. So moving on, apart from the commitment to evolve our tech arm as a profit center, we, in our view, have been able to deliver on all the commitments we made. Yes, unfortunately, our profits couldn't be where we wanted to be, and I'm mindful of it, and I'm fully responsible for it with my team. But really, it was a decision beyond our control, which, as we've explained, we do plan to appeal. Just to recap, we had given 8 commitments at the beginning of 2021, and we have been updating every quarter the progress, and the following slides will be kind of a report card on those 3 years that we've had. In terms of retention and growth, we had made a commitment that we will grow between 25 to 33%. We have grown 26%. I would have liked it to be on the higher side, but it's still within the range of 25 to 33. We were slightly impacted by the fact that travel didn't come back as fast as we wanted it to come. But overall, as you can see, the growth has been strong, and this is despite a material reduction in our commercial portfolio. So as you can see, our GWP mix, commercial has gone down from 39 to 8%. Lifestyle is 73%, and that's where our big focus has been. Lifestyle has grown. Retention has also hit the 70% that we committed, which means the company is now set to manage expenses more efficiently going forward, because we'll be able to spread the expenses to the top line more effectively. SME, the growth basically came from bond and liability. The remaining SME business is actually high retention. As for commercial, as you know, we've exited large commercial entirely. Most of it is just a last reminiscence of, what's left. In fact, for the year 2024 onwards, I don't intend to have any commercial. If at all, it's probably just a little overhang from last year, but there's expected to be nothing. Moving on. Our 2023 NWP was slightly lower versus last year, despite the absence of Tenang business. We would have grown quite strongly if Tenang business was excluded, but nonetheless, it was still there. And if you look at our growth rate, it is, again, our retention is well above 70%. If you look at our growth rate, it is coming from health, it's coming from SME. We were slightly impacted for sure by the travel growth not coming at the pace we wanted it to come. Although early indications are that it seems to be finally coming back. There was a capacity limitation with a lot of the airlines that we saw in last year. The travel and motor led our top line growth. if you look at the numbers, our fourth quarter retention was up 14%. It's at 88%, which I would say finally puts us on par with proper insurance companies, which means this company is now a proper general insurance company. And our NWP grew by 8% in the quarter, led by lifestyle. And travel NWP has grown, but we expect it to grow much higher in the months to come. Digital partnerships has grown significantly. From a small base of 55 million, we are now at 156 million. Yes, it's a decline over last year, but there was a big 62 million business in 2022 for Tenang. So if you take the Tenang impact out, it's for 38% growth even in last year, but that's not how we want to do it. Even with Tenang, which is still a business, we are talking about growing from 55 to 156, which is almost 3 times in 3 years. NWP split by what we call digital and non-digital partners. When non-digital also it is done digitally, but it just means there is someone who is facilitating it, like a broker or a partner there. A number of digital partners has grown to 79%, 79 from 15. We have done some cleansing of this to focus on people who are adding value. And I think key partners we've added is ViaJet, Voltec, which is including Samsung. We're working quite a bit with Policy Street. Okay, moving on. We've just gone live with our latest collaboration with BigPay. It's a typical travel plan. So obviously using the infrastructure that Capital A provides. So that's live as we speak as well. We have launched Flexi One, which is another quite an innovative product. If you haven't tried it, please try it. I personally think it's the best UI UX in town, and Chulingham team have been able to launch something quite unique. The AI plan recommender is completely in-house. It's our IP, and I think this is just the start, and you're going to see a lot more AI plans coming out and implementations in the space with Joseph and team driving this. We also had a virtual assistant option, so you know about some of the new insurance concepts that you see in countries like India with Ditto and so on. Virtual assistant seems to be quite an interesting way of finding that mix between a traditional agency and a pure non-personal channel. And it's a very interesting product. It gives you complete flexibility, and I think we've focused on flexibility because we believe that there is a huge market we speak to for whom the traditional method of need-based selling will not work. For them, it's more about affordability. So the traditional insurance way of saying, this is the need, that won't work for someone who is young and has less affordability. So we are looking at what can you afford. If you cannot afford in a set month, you can tweak your coverage down and up. So it's been very recently launched. Do check it out. It's a very interesting innovation from our side. These are just a lot of the promotional campaigns, just to let you know we're going quite aggressive on the e-commerce side. On the next one, on the combined ratio, our combined ratio on an MFRS basis will be below 100% if we did not have Tenang. It's been driven by increased retention ratio through reduction of large commercial premiums as well, but also with the mix we have. To evolve obviously with Tenang, this combined ratio will be higher, but we are treating it as a one-off impact, which we did not have much control over, and I can talk about it later. To evolve our tech arm, I think we did put this a little bit in the back burner, as I mentioned before. The reason because our existing business, as you saw, is growing at 26%. It needs a lot of support. In that backdrop, a lot of the focus has gone to our existing businesses, digital partners, etc., that we are building. Nonetheless, it's, as you can see, it's been able to grow its revenue, but also more importantly, start to add a lot more partners and markets. Tech is the backbone of our organization. Travel B2B, which thousands of agents use in different countries, It's very interesting that this is something you will see. We've just launched in Malaysia and Thailand last year. We're going to soon launch it in Vietnam, which we are expected to sign a partnership agreement there. So there'll be more markets coming on. We have obviously continued to invest on API, the middleware, the market space, and so on and so forth. We are obviously enhancing our system to not just do travel, but also non-travel. So we will be very soon launching pet health, which I spoke about a year back. There's been some delays from a product feature, etc. perspective, but we will be launching it. And the good news is we will also be charging between a percentage of GWP for using our system to the partners. So again, it's inbuilt on top of our travel tech. So we're starting to also get other business accounts that you can see. So you can see the policy issued count, and you can see that we continue to be quite flexible in how we service the customer. Our ASEAN presence has grown quite a bit. Unfortunately, we couldn't do any of the inorganic one that we talked about. But organically, we've grown Vietnam quite a bit. And it's largely through e-wallet, e-commerce market space, airline, PA for loan protection. It's been a host of products. As you can see, the number for Vietnam went from 0.5 to 36.9. I expected it to be closer to 50 million, if you ask me. But I'm expecting this growth to continue in 2024, and I'm looking at Janet as I say that. We recently went live with our China outbound sales as well, 28 February. Due to regulatory hurdles, the process has taken much longer than I expected, almost 12, 14 months. But anyway, it's gone live. And we are hoping to activate India very soon as we speak. On the mobile side, I think very similar message to what I gave in the last quarter. Numbers have grown. More importantly, we are starting to see sales conversion pick up with minimal intervention. So once we get the customer engaged, I think there is a lot of positive uptake we are seeing. So the key is how can we get this download number even more, which is why we're doing a lot of activities. You will see there are 3 major activities in the next 2-3 months. We are one of the sponsors for the music show Loop Festival. We are also one of the sponsors for the Legends football event between Liverpool and Manchester United. Although I still don't know why those teams are chosen and not Arsenal, but that's for another day. So we continue to look at events where we can increase our download, because once the download increases, I think we are able to get customers to buy more. I will now hand over to Lisa, who is the customer champion for us. So a lot of this positive story is her and her team's achievement. So I shall hand over to Lisa.
Thank you, Rohit. Let me get them. Thanks. Hi, good evening, everyone. So just let me give you a very brief background of what NPS is all about. We have started our NPS journey since April 2021. It was the score was -16, but as of December, the latest NPS result, we have achieved a very favorable outcome of +45. And of course, when it comes to partner, it's always the top-notch result of +60. So when it comes to next, Rohit, next, thank you. I'm so sorry. Okay. When it comes to the transaction NPS, we are maintaining a very good sentiment among the customers that when we started our transaction NPS back then in Q1 in 2023, the result was about 42, and we are maintaining at above 50. And the latest result of Q4 2023 was +46 due to the sample size reduced by about 60, more than about 100%. So when it comes to purchase journey, purchase journey is where we need to improve further, and we constantly encourage our customer to give us more feedback. so that we will continue to improve the overall CX journey. And this year, we're going to work with Joseph, aggressively to see how can we improve the overall digital platform. And when it comes to our call center on the customer satisfaction, the issue resolution and also the satisfaction on the explanation is all above 80%. So thank you for the entire team with all their support and also the effort to bring this up so that we are living and breathing in terms of our CX promise of 333. Thank you. Okay, something that which is exciting for latest CX initiative and award, we have also, in terms of compensating our Malaysia Airlines, the MY airline, for the traveller. For those who are, the Twin Protect Traveller Insurance policy holder, we have actually compensate them, with a cap of 200 ringgit per traveller. And on top of that, we have continuously to improve our digital mobile, first company for the insurer to be digital roadside assistant, to continue to improve in terms of the towing geolocation preferred. The customer will be able to submit claim, and at the same time will be able to select the preferred panel workshop. First notification of loss we have just launched in January 2024. And thank you for the entire company, the staff, their effort, and also the support. We have received, the award from Insurance News on the Claim Initiative of the Year, which is the parametrics claim, and also on the CXP Best Customer Experience Award. Thank you.
Okay. On the customer tracking metrics, I think we've been updating regularly. Obviously, the unique customer count did drop in 3Q and 4Q because the travel volume was not where we wanted it to be. And obviously, the last year was the highest because of Penang, but overall, the number is, I would say the key is we are increasing product per policy per customer. And you will see in our new plan that we will announce, I think later next month. You will see that there's quite a focus on product per customer that we are doing as a company. So that is something we want to continue to drive because we don't want to just acquire customers, but we want them to stay longer with us, buy more from us, which you are seeing the vintage years are increasing. And we continue to acquire interesting mix of younger base of customer, etc. The other promise we said is we want to change our organization quite a bit. So we want to be a much more younger choice for employees. And if you look at our brand surveys also, that's what it shows, that Twin Protect is quite a young and vibrant company. So from a minus 16%, our employee NPS is at plus 19%. We are also the preferred employer in the graduate choice of employers, and this is something we do want to do. This will help both efficiency, but also in terms of how we position the company with a much younger base of people. FTSE for good, we expect the rating to go up from 2.7. It went up from 2.7 to 3.6. The minimum rating was 2.9, so it's quite a good achievement. We have made it to the FTSE for good, and we remain the only insurer, conventional insurer, because we understand Sharia Takaful is also doing things. On the commitment, quite a bit of things that we have done. Zero paper. We do give charity when we sell products online. We've enhanced our policies. We have been able to get most of our roles from within, so we're not going and hiring people. So we build a more sustainable organization. NPS has been quite important. In 50% of our leadership team being women, we haven't achieved it. It's right now at 43%. Key challenges and what we could have done better. We did make a good recovery, bouncing off the lows of COVID for sure, right? Because this is a company that was living off travel, living off AirAsia, and obviously the COVID years were tough for both. And we have been able to build more travel pillars, and B, not just depend on travel, but build other lines of business like PA, device protection, motor, etc. A travel top line achieved a CAGR of 19.4% between 20 to 23. It's below the budgeted growth. That's definitely hit us. And the company grew at 26%. So travel grew slower than the company. which obviously is not ideal. And I hope 2024 will be a different story with the China border, China being a lot more open. Like right now, there's a visa-free travel into Thailand, so some of those could help us. White label did not turn into a profit center because, as I mentioned, a lot of the resources went into our partnership execution and key in-house projects. We are running multiple projects executions at the same time. I always tell people, right? Most companies would do a core system transformation once in their lifetime. Others would do maybe in once in 10 years they would do a sales front end transformation. And most insurers are now still grappling between the cloud transformation project as well. And Prashanta here probably has multiple hearts, so he decided to do all three together, which is quite a major game changer. We are at about 61% completion rate on our cloud transformation, which means moving all our systems to cloud. We expect to complete most of it this year. We expect to go live with both our new front ends as well as our new core system this year as well. It is delayed roughly by about 6 months. But as I mentioned before, we expect to go live. So we've gone live on a few products. The main products of motor, travel, and health, we will be going live this year, with motor expected by early H2, end of H1, which means the system will be, it's a big change from an efficiency standpoint. There are definitely new learnings from the Tenang situation. I'm definitely disappointed. I want to definitely put it out there that I don't think it is our intention to give this surprise. We believe we have done things in a certain way, but with all respect to the regulator who has the powers to decide, and they have decided that they would like us, they wouldn't be approving some part of the policies. Team Protect Ventures, which is anyway a sandbox venture, hasn't been able to gain traction. As you know, it's a 1-year sandbox, so obviously we are currently having discussions on what we're going to do about it, and what tweaks, if at all, we need to do. So obviously that's something that we definitely could have done better, but there's learnings there. Definitely we've been able to innovate, but we've not been able to gain the traction we expected to be. I will hand over to Hao.
Thank you, Rohit. Okay, I think this slide basically, I think Rohit has already covered that. So maybe we move to the second slide. Okay, I think as shared before, I think last year during the Analyst day, so this is the new ratios that under MFRS 17 that we will be measuring and we'll be sharing, I think, moving forward. So maybe just to expand on, I think, Rohit's, what we share on Tenang impact to us that through the announcements that we made. So Tenang, basically how it's been treated is basically we have actually put in receivable impairment provisions, which under MFRS 17, any receivable impairment provisions are supposed to be presented on your top line, which is insurance revenue. So that impairment, as opposed to previously under MFRS 4, it will be shown under management expenses. Under MFRS 17, it will be shown as a reductions of your insurance revenue. And other than the reduction in your receivable impairments, the NUM will also give us two additional impact. I think one is basically a commission clawback from the partners, and then the second portion is basically there was a small portion of unwinding a reinsurance arrangement. So if we were to consider all these three factors, and we actually have tried to make an attempt to show how our performance will look like excluding the Tenang impairments that we put in our announcement. You will notice that under our net incurred claims and attributable expenses ratio would then basically be approximately 42.8%, which is still higher than 34.3%. And the increase in this cost ratio is predominantly because of the strategies of the companies to gradually exit from commercial business. As everyone is aware, I think under the new MFRS 17, insurance revenue now represents or is against gross earned premium. As compared to before, which basically under MFRS 4, I think you have always been more maybe familiar with net earned premiums as compared to gross earned. So when we make a decisions to exit from commercial, that generally would means that basically our insurance revenue number may be impacted or it may actually come down. However, I think with that impact on the incurred claims ratio, you will also be expecting that our reinsurance ratio to be also declining. The cost of reinsurance should be declining because I think by exiting commercial, I think which we have very low retentions, it generally means that actually previously our commercial book have a high retention and high reinsurance cost. With the decisions to move away from commercial, our retention ratio actually has improved, and that will also contributed to a reinsurance cost ratio to decline. And that you will notice that excluding the turn-on impact, our reinsurance cost ratio basically declined from 36.1 to 16.3. All in all, I think basically that what that means to a combined ratio, I think in Q4 23 versus Q4 22, there is actually a slight improvement from 96% to 95.5% year on year Q4. If you were to compare FY23 versus FY22, that basically there's an improvement of approximately 2.5% that we have observed, I think, from 97.8 to 95.3. If we move on to the next slide. Okay, so below the combined ratio line, which is basically our net insurance service result, basically there are three main other factors before you actually flow down to our PAT lines. The first one is basically investment income. Second is non-insurance related income and expenses. And then the third one is basically share results from our investment in the associate companies. So during the quarter of 4Q23 versus 4Q22, though you actually notice that there was some decline, I mean year-on-year comparison in our investment return. However, that was pretty much because of we did enjoy a strong rebound of our equity portfolio, especially in the China equity back in 2022 in Q4. However, we since I think we have exited fully from our equity portfolio in Q1 2023 with the investment strategies to pursue more stabilities in our investment returns. We have now actually approximately 78% I think of our investment portfolio are actually invested in MMF and also FD, which actually give us a fairly stable returns. And for the year, I think we have achieved approximately 4.4% investment returns. And you should be expecting basically the investment income Q on Q to be fairly stable at the current range of approximately 7 to 8 million. Total other income and expenses that actually recorded quite a huge decline in our net expenses. Generally, I think because of a few factors. I think in Q4 itself, the reductions generally come from two main areas. One, there was a write-back of a credit balance from reinsurance SOA, which was in relation to a period prior to MFRS 17. Sorry, it's getting a bit accounting. So under the accounting standards, basically, if you were to do any adjustment prior to basically the cutoff date for MFRS 17, you will actually park it as part of your other income and expenses. And that write-back generally means that we have, in short, in the layman term, is that we have over-provided for liabilities, which subsequently we can justify that those liabilities are in excessive and we are writing them back. So that actually gives us an upside of 2 million. And on top of that, basically, we have also, white labels have also grown in this business to be able to cover more of its overhead costs. And then we noticed that white labels quarterly losses basically have also reduced by 1 million as compared to 4Q22. These are, I think, the main reasons which actually contributed to improvement, I think, in Q on Q, other expenses of the group. Whereas I think if I were to switch the view to FY23 versus FY22 on total other income and expenses, we do benefit from some other areas. One of the major areas, like what Rohit mentioned on our digital life sandbox, when we first kickstart, I think in the second half of 2022, it come across as pre-operating expenses, which fall under the non-insurance other expenses line. Whereas I think in 2023, I think these costs have, because we have kickstart in Q1 23, these costs have been moved to insurance related expenses, which is part of your ISE, insurance service expenses. Hence, I think it will also reflect as a reductions in our other expenses or non-insurance expenses. Okay, other than that, I think the other impacts I think are the reason are fairly consistent compared to 4Q23, which is due to an improvement in white label's bottom line performance, as well as basically a write back on excessive credit or excessive provisions that we have in the previous year. Lastly, I think also want to just touch quickly on share result. I think year on year, you notice there was a huge improvement from a negative 16.6 million to a positive 300,000. That is contributed by an improvement in TPT's performance. Back in 2022, I mean, if you recall that we were actually, our Thailand's operation was actually hit by two main factors. I think one of which is actually an impairment provisions on a reinsurance litigation case, which we have also shared updates, I think, in our recent announcements in our Bursa report. The second factors was due to high claims reserving due to unfavorable COVID situation in Thailand back in 2022, and since then actually has recorded a significant improvement in 2023. So with that, I think that's where I think despite I think the Tenang impairment that basically we're booking for FY 2023, we have still recorded basically a marginal profit of 200,000, 245,000 versus FY 2022 of 34.6 million loss after tax. And if we were to exclude the non-impact on after-tax impact, our FY 2023's profit after tax would have increased to 22.7 million, I think, as compared to FY 2022 of a loss of 34.6. If we can move to the next slide. Okay, I think as I explained just now, I think our investment portfolio and strategy has moving towards more conservative to minimize volatility in our investments return performance. So as you notice, I think basically we have actually moved out actually unit trust funds, reduced the holdings, I think from 97% back in 4Q22 to 52%, and where it has moved to, basically we have made some placements into fixed deposits, which actually offer quite a high returns, I think, to us relative to money markets. So collectively, basically within our unit trust funds portfolio, we currently have 60% of unit trust funds are actually invested in money market and 40% in fixed income funds. If we to consider the fixed income, fixed deposits as well as other deposits as well, that generally means approximately 78% of our total portfolio are currently being invested in money market plus I think deposit, which will actually kind of assure a fairly stable returns, I think, to our investment returns, I think, in the foreseeable quarters. Okay, I think with that, I think I'll just wrap up the financial sections and pass back to Rohit.
Okay, so I would like to end, I think, by saying that I am sure some of you are disappointed about the announcement we made 10 days back. We can explain more if you have questions, but from our perspective, we believe that, it was a business we did, we were servicing the business, we were paying claims. So it's a bit unfortunate that the debtor decided that we will not get a payment. Hence, we have tried to present without Tenang because the quarter would have been very different and the year without Tenang. So obviously, if I exclude Tenang, we have made significant progress on our 8 commitments, with 7 of our 8 commitments actually making good progress. And despite this massive hit that we had on Tenang, even then we've been able to break even, which versus last year when we had a huge loss, is an improvement on its own, but we obviously expected much more profit. As for the next 3-year plan, we will have something that will be announced very soon in our corporate day plan somewhere in March. We'll keep you posted where we will be presenting our 2024 to 2026 plan. And I look forward to having a conversation with you.